Right guys, so I hope you truly enjoyed that first video there, looking at the art of discretion. Now, in this second video, what we're going to be having a look at is liquidity. So, understanding liquidity, where can we find it, what is it, and how can we use it to trade? It's a super valuable concept and something that we've used in our trading for a very long time. So we're quite excited to bring this topic to you. Hopefully it can provide you some value and hopefully you can see just how powerful that is. So let's get onto the screens and have a look. Right guys, so now you join me on the charts, and what I've done here is just drawn up a few diagrams so you can kind of understand this in its simplest form. So looking at the top left diagram, we can see that we clearly have a double top and we clearly have a push above there and a push to the downside. So what we can assume there is liquidity was above this double top region. We came up, grabbed the liquidity, and then pushed in the intended direction. Again, that's going to be the same with double bottoms, triple tops, triple bottoms, and all that sort of stuff. So why is this? Why is liquidity above and below these levels? Now, what we can assume is when people first get into trading, very simple concepts are support and resistance, double tops, double bottoms. Okay, so if you go on YouTube, type in how to trade, there will be a video there telling you to sell at double tops, buy at double bottoms. So naturally, institutions, big boys, banks, they know it's a very simple understanding of the market. They know a lot of people will be trading that way. They know their stop losses will be above this level. So what they're going to do is push price in that level, in that direction, take the liquidity, and then we're going to push in that intended direction. Because obviously what we're looking for here is sell positions. People will be looking to sell it once it comes back here for a triple top. And then naturally what's going to happen, we're going to push in that intended direction. So yeah, a place we can find liquidity is above, below double tops, triple tops, double bottoms, and triple bottoms. You get what I'm saying there. So yeah, essentially what we can do then is highlight these areas within the market. We can then wait for price to pop above them and then trade accordingly. Now, as you know from what we've previously touched upon, we do like to trade patterns here at the Social Traders, and what we can see there is we can actually trade that as well. So we can actually catch these liquidity grabs by understanding price action above those areas and understanding the patterns and how we can trade them. And again, don't worry too much if you don't know how to go about it or the different variations. Again, we do cover that, in depth within our strategy. Now, if we look down to the bottom left, we can see that we have a trend line. So again, when you do come into the industry and you're wanting to learn how to trade, again, a very easy thing to understand is trend lines. So again, what we can see is we have one touch, two touch, which means we can draw a trend line. And then naturally people will be looking for that third touch to take price to the upside. And again, this does work. It's not something that, gets blasted through every time. Again, it's all going to be based on how price action approaches that trend line, because we can break through it and continue in the same direction. Sometimes we'll just break through it, reverse, and then continue. Or sometimes we'll correct into it and then we'll move away and respect the trend line. So again, like we've previously touched upon, we're not using trend lines as a force field. We're using them as a guide, and then it's about understanding price action. Now, what we can see here is price pushes to the downside. Again, people are going to be, buying in this area. They're going to have their stop losses below. So the price sometimes will push out, grab liquidity, and then continue in that same direction. Now, something we teach here at TST is pattern separation. And this is actually, something that we can catch and something that we teach and we talk about quite often. So what we can actually see here is we do have a pattern again, and we have a 1, 2, 3, 1, 2, 3, and we've continued and pushed to the upside. So again, this is all down to market phases, understanding the bias, understanding the direction. We know that when we push to the upside, we do a correction. Just because there's a trend line through here, it doesn't mean we're now going to move to the downside. Just because there's a correction there, we will go and continue that push to the upside. So hopefully that makes sense and you can see exactly why that happens. Again, there's going to be loads of different variations of this as well. It's not going to be picture perfect every time, but hopefully you can see how that works. So again, we're going to have liquidity below and above trend lines as well. You will see it time and time again, where price will go and push through a trend line and then continue in that same direction. So there are two examples there. And if we look at the right-hand side of the screen here, you can see that we just basically have price. So when we're looking at price, and it gets taught at a very basic level, we can see that, naturally price will move like this, okay? And it does to some extent, but we know that within here, there's going to be, higher highs and higher lows. Within the pullbacks, there's going to be different variations. And again, there's going to be so many different things that happen within all these legs. We can see it's a little bit more complex than just like this. So again, there's going to be loads of little higher highs, double bottoms. There's going to be liquidity taken within all these lows. There's going to be liquidity above every high within the market. There's going to be liquidity below every low in the market. So basically what we can assume is there is going to be liquidity all over. Now, something that we see quite often is we'll see a double bottom. We'll see price gather liquidity below there, and then we'll see price push to the upside, and we'll come back in, and then we'll continue. Okay, so we see that sort of thing. We'll also see, a low created in the market like this, and then we'll just completely reverse, and then we'll come back into that level and continue. So again, what we're doing is we're gathering liquidity from the low. We're then breaking our highs, giving us direction. We're then corrective to solidate and kind of concrete that idea of upside movement. So what we can assume is there's going to be liquidity below every low and above every high as well. So hopefully that makes sense so far. Obviously, if you don't understand all these concepts, we do teach them in the course as well. And then what we can also look at is patterns. So the reason we actually trade patterns is because, again, it's a different way to account for liquidity being grabbed. So as we know, we can trade patterns above double tops and below double bottoms. They don't always have to perfectly line up. We can trade them to break patterns again and break trend lines, again, gathering that liquidity. But what we can also assume is we have sellers here, we have sellers here, we have buyers here, and we have buyers here. So again, what we can see is patterns are basically just, it's like consolidated price, but because it's ascending or descending, it gives you an idea of where that consolidation is then going to move to. So what we can assume is, again, there's going to be liquidity above each one of these levels. And that's why we always look to actually take an entry on the third touch. So what we can assume is people will be buying here, and people will be selling here and selling here. So you can see that that probably is a little bit messy in the minutes. Let me try and clear that up ever so slightly. So what we can see is people are going to be buying and selling on each one of these levels. Yes, that is very messy. I do get that. So I'll try and explain it a little bit better. So price will push in, and then people will sell it here. Price will then push away. People will then buy. And as you can see, price pushes above that level, stopping these people out. Then people will try and sell again. They'll push it back down. And then buyers get back in because this is a higher low. And again, we push the upside once more, and we take stop losses from both of these levels. Now, liquidity is essentially orders within the market. It's people's stop losses, it's buy stops, sell stops, and so on. It's where people's positions and stop losses and take profits are situated in the market. So what we can see is when price pushes up, it's taking out sellers. When price pushes up, it's taking out sellers. And then when we get that push to the downside, it's taking out both our buyers there. So hopefully you can see how patterns are another way to understand where liquidity is and to make sure that we're not getting caught on the wrong side of the market, which is just a crucial part of trading. It's so important to remain on the right side of the market. So hopefully that makes sense. Hopefully you can see where liquidity is situated. We have it all over the market, and these are kind of specific ways that we can actually trade it. So what we're going to have a look at now is how you can actually get caught sometimes if you don't understand where liquidity is. And then we're going to have a look at how we can actually use it to our advantage in order to trade. Right, guys, so now we're going to have a look at an example of a technical strategy on its own. Some people refer to it as a retail strategy, but clearly what you can see here is we do have a trend line to the upside. And as previously stated, we know that once we have two clear points, we draw that together, and it should give us an area for our third point to then go and move to the upside. So that's typically how it works. So as we've previously stated, we know that we want price action to be very corrective into the trend line in order for it to reverse. Now, if we were going to look at this from purely a technical point of view, or what as I've said, what people label it as a retail strategy. What we can do is obviously add a Fibonacci on here as well. We'll just drag that down. So it looks like we could have the 71% fib there. Okay, so we can have that in there. We've got a level of structure, trend line, and so on. And what we can do is, look at this area here, wait for a reaction, and then take a buy position. So what I'm going to do is just play some candles out. So there we go. Got a lovely reaction off that area there. Nice engulfing candle. We can put our stops below here, and we can look to target, the extensions for possibly 1 to 6.8. So not a bad risk to reward. A lot better than what some people who trade these methods do take. Sometimes people have massive stop losses aiming for 1 to 1, 1 to 2. So slightly better than usual. Now, what we can do is start to play out some candles. And you see that we do get a bit of a reaction here. We do start to push to the upside. So, potentially we could get break even here if you do get break even aggressively. But what we can see is price does kind of work its way back to the downside there. Stops our trader out. And as you can see, we push to the downside ever so slightly, and then we rock it to the upside. So again, we can see that concept I spoke about, it's definitely, it's worked out here. We can see that. So again, we have liquidity below this trend line. So naturally, people are going to come and take that liquidity from the market. The big boys institutions, they're going to come and gather liquidity. Okay, so we know that we have, potential stop losses below this level as well. So we can assume that, price was going to come and gather liquidity from there as well before we do go and push to the upside. Okay, so if I just strip this back now, I'll show you exactly how we could have approached this and how we could have potentially done it differently to avoid taking a 1% loss. And this was actually a trade that was shared with our community, and this is exactly how we capitalized on this position. So looking at this, what can we see? So again, we do have a trend line, but we don't have to go off the trend line. So like I've spoken about, we have trend line or pattern separation. So we can just separate that. We know that we're still in the uptrend. We can now focus on this bit of price here. So as we can see, we don't really have a clear pattern into that area of interest. So I'm not too interested. We can see we're slightly corrective, but it's not really a clear pattern. So I'm not too bothered at this point. So what can we notice? We have a low, we have a high, we have a low, we have a high, low, high. So for me, this is kind of our last low. This is our lower area. And we kind of need to stay above this level in order to stay bullish, in my opinion. That's kind of what I'll be looking for. So if I just start to play out some candles now, you can see how this is different. Okay, so we can see that we didn't get the commitment there anyway, so we're not too interested. Price pushes down slightly, and then price pushes down once more. Okay, so at this point here, what can we see? So we can see clearly that we have an impulse to the upside. We then clearly have a correction to the downside. So naturally, we'll be looking for that next impulse to the upside. Okay, that's typically how we look at the market. So again, if we saw this sort of price action into the trend line, then 100%, the trend line then makes sense. But because we didn't have that clear price action into the trend line, then you can see that that's why we didn't get the commitment and we actually pushed lower. Okay, so what else can we see from here? So we have liquidity at the double bottom. We took that. We have liquidity at the double bottom. So naturally, we should probably come below this level once more. So what we can then start to do is add on our patterns. We can start to draw our structure. And again, don't worry about how to trade these properly. Again, like I've said multiple times, we do teach this within the course and the community. So naturally, we'll be looking for price to pop down ever so slightly lower. Give us that third touch of the pattern. And as you can see, that is in this area here. So we just drag that out. So you can see again, we have just broken our lows there that we wanted to stay above. But again, we haven't broken it with that conviction. We have broken it correctively, again, which we know is just another form of grabbing that liquidity, sorry. So this looks very good here. So, we could wait a couple of candles here. 1, 2, 3. So that looks like a nice place to actually go and take an entry there. So we could potentially get in here with, 15 pip stop loss, relatively quite tight there. And then first targets, we can have the 90%. We've got 7.6% there. So we just start to play out a few candles. Obviously, you saw the kind of reaction we got there. Really, really nice move to the upside. And again, this move does go on all the way to the upside, and it did really go on to bank some serious percentages. If we just zoom out here, we can see that we have our highs over here as a first target, and we have our highs over here as a second target. So, you know, even if we just take price to our first target there, you know, we can probably see that that is around 1 to 13. So pretty good trade there. And then if we do hold it all the way, because again, nothing's really changed here. If we jump back down to the smaller time frames, again, this is why understanding price action is so important. So again, we have come into a double top, which is what that black line is. And we can see that price action moves away from that level, very descending, very corrective. So we continue to the upside. Again, we have a double top, so people will be looking to sell. And the way we move away from there is descending and corrective. So again, we move to the upside. Nothing has changed. And this is why understanding that price action there is so important. And then obviously, if we do look to target that higher level like we were looking at, we just continue to play out a few candles here. See that we do go and touch that level. So that was a really nice trade there for about 33%. So really, really nice position. And again, you can see these little liquidity grabs here and there. We can see that we broke our low here and then went and pushed to the upside. So essentially that's just taking liquidity out from these previous buyers here before the move happens. We can see we have lows here, liquidity comes and grabs it, and then we push higher again. So you can see that concept playing out time and time again. And I hope you can see there just how we'd actually go about that, just how we'd account for that liquidity, and just how we account for a little bit of extra development to, you know, give us that certainty behind the trade. We're not just trading those technical, you know, kind of retail methods. We are looking to kind of add our own twist with our patterns, understanding of liquidity and all that sort of stuff as well. And you can see that instead of taking a 1% loss here, we've actually gone on to bank 33%. So lovely, lovely example there of how those concepts tie together.